Hello, my name is Lars Fontinen from whentotrade.com. In today's session, I want to talk about the importance to detect and to track dominant sentiment cycles. Within this example, I will review a live market example which I've shown just in advance. So I will guide you through the process on how to use cycle analysis in the current market conditions, and we will review the current market situation right now during the recording. So let's start of all with the current market situation as we have observed it in summer of this year. So this is a chart of the New York Stock Exchange Composite Index, dated 9th of June. This was the exact date as I did the live analysis which was posted, so we will review how I did it and what will be the results here. What you see here is quite that the market is in an upturn and an upturning trend just from the year of 2012 through 2013 and also in 2014 just up moving. So the question which is going on by most of the analysts within this uptrend, where are we going? Where are the markets going? So this is one of the interesting questions which every trader and analyst and investor would like to answer at the beginning or in the mid of June 2014. So let's see what the media has provided us with information. So here's an example of what some analysts posted, like the Market Watch stock market prediction. That's kind of scary, which was published in June of this year with the result of the expectation for US equities to rise another 10% just until end of year. So or let's review another market forecast which was within the media. So the one reason the stock market crash simply won't happen. So even that you would expect sometime if the market goes down, there's a lot of optimism around thanks to Fed policy, which continues to make safer investments unattractive to investors. This was in the mid of May, so just 3 weeks before this market situation. What we can just move on and review these optimistic statements here. There's another statement done on June the 8th, so just at the point of this market situations, stock bulls see just more reason for optimism. So there's a lot of huge optimism going on in the markets. So we can pull up a lot of examples here. There's on CNBC Yahoo Finance News, where another analyst posted just, we are about to enter the greatest bull market within 85 years. Also posted on June 8th, 2014. Just remember, this is June 9th, so exactly at this day, the media was just full with bullish statements out there. So we can go on, like the Forbes magazine posted an article about why investors shouldn't be too skeptical about the stock market right now. So even if you get skeptical about this up move, they just posted it's no problem, the stock market will go up again. So I mean, basically, you can take these public bullish magazine articles as contra-indicator regarding sentiment. But however, this is not reliable investing in here. And just if you look at the stock market research during these times, you will find a lot of mainly bullish statements there. Just to switch to the European markets, this is another example of the German DAX index, which is also in an upturn, similar to the US markets. So there's a Bloomberg news on 6th June, stocks remain undervalued at this point of the analysis. So stock markets hits records of 10,000 for the first time in history of this index. But however, the takeaway is that despite the rally, German stocks remain undervalued. So this is a message from Bloomberg news here, just in the European market. So you see even just well-known magazines and business magazines just called ongoing stock market rise here. So, but now let's switch to our knowledge about cycles, and especially here about sentiment cycles. I mean, one of my favorite ways to analyze the stock markets is just to review sentiment, because sentiment is not jumping from one level to another, up or down. Sentiment just moves in cycles. So you will see sentiment slowly moving up, reaching a high, and then coming down and reaching a low and going up again. So this is quite normal with these sentiment issues. And so sentiment and fear and mainly drives the markets out there. So, and the good thing about the sentiment in the markets is that it does not jump abruptly. So one of the driving forces regarding markets is the sentiment behind the markets, the sentiment behind the investors, the sentiment in regards to the current market conditions, the sentiment that we have in relation to what we think about the future. So it's all about sentiment on how we rate the market and the future outlook there. So you will see a direct link and correlation between sentiment and stock market. So as sentiment moves in cycles, it would be nice if we find a way to detect and track the dominant cycles which are currently active and drive the sentiments. So I want to introduce you with some ideas on how to analyze sentiment cycles. So for instance, and I want to point you to that to this index here, there's a so-called St. Louis Federal Reserve Financial Stress Index. It's a relative new index. I think they created it in the year of 2010. So we have these real data since 2010. For sure, it's back calculated in the 1990s again. So, so there's an index which is published by the St. Louis Federal Reserve Bank, and it uses 18 weekly data series to measure financial stress in the market. So the interesting point here is that we get weekly updates here from this data, because mainly if you see the main sources to compile a financial stress index, there's mainly monthly resources out there. So it's not easy to get accurate real-time data on these financial stress situations. So it's one of the first of its kind which offers us the opportunity to update this information on a weekly basis in the market here. On top of that, it's not just one simple indicator. It's a combination of 18 series just listed here. So there's one category that deals with interest rates from 2 years to 30 years treasury bonds. We have the yield spreads included there with a lot of sources giving their data. And we have some additional indicators like the emerging markets index, the S&P 500 index, or the volatility index, or also the VIX index here. So they're using principal component analysis, which is a real in-depth mathematical statistical analysis method here. So it's not just a summary out of these 18 data series, it's a real high sophisticated statistical measure out of these 18 series. And then they produce a composite index, which is just shown here on the right side of the chart. This is the so-called financial stress index published here. And a value above 0 means that we have a high stress level. So there's high financial stress in the market. Values below 0 indicate that we have very low stress level in the market here. What this means that if you're familiar with the financial stress or sentiment stress index in the markets, you will quite know that low points in financial stress will correlate to market highs or tops. So once you have a very calm situation regarding the financial outlook, the financial situation, this correlates to rising markets and especially to market tops. If you have a high stress or an fear in the markets, so a high stress level regarding the financial system, very, very uncomfortable situations, fear in the market about the financial condition, which means that you have a high stress level, this in most instances will correlate to market lows, as the lows indicates the point where there's the highest financial stress in the market. And market tops relate to the situations where we have the lowest financial stress in the markets. So once you are able to detect the turns in the sentiment of financial stress, you will be able to spot the market turns also. But however, you go with a primary set of data, because sentiment is driving the markets and not the markets are driving sentiment. So it would be quite a primary data set if you are able to identify the cycles within the sentiment, because this is the leading source, this is the leading indicator. This is why I would recommend to concentrate on the financial stress or sentiment market series to put cycle analysis on. Okay, in this example I've used the financial stress index here to check the dominant cycles. To use or to do this kind of cycle analysis, we will now pull out a chart of the St. Louis Financial Stress Index here. So I've used Quandl as a free data source available here, so everybody can use this data based on this symbol here, and just we will load up a weekly chart, because this data is provided on a weekly basis here. So we use the WinterTrade charting platform here, which then includes all these cycle analysis, and just open the chart. And this is how the financial stress index now looks plotted on the chart here. So here you have the 0 level, which would mean the neutral level. Above 0 we have high stress, and below 0 we have low stress here. So this is the situation today on the 9th of June, where we do our analysis on. So we have up to the day market data for the financial stress index here. What you need to do if you will put on the cycles tool set. So one of my favorite tools is the so-called Dynamic Cycle Explorer. The main issue of the Dynamic Cycle Explorer is that the Cycle Explorer is able to detect the current dominant cycle within the market. And that's not all. The Dynamic Cycle Explorer is able to track the shifts within the length and phasing of the dominant cycle. And this is quite important, because cycles will not stay static within this series. So cycles morph a little bit around their length parameter, their phase parameter. So it's quite important that you not just do a static cycle projection in the future based on past cycles. You need to track the current main vibration of the dominant cycle. And this is what the Dynamic Cycle Explorer is doing. Within the WinterTrade platform, it's all automated, so you just select one of the top points in the past to start this cycle series. Here I've just picked for this example the October 2002 market low. You see it's here on the smaller chart. This is the New York Stock Index today, and back in 2002 this is the market low, and this corresponds to this data in the financial stress index here. So what we will do now with just one click, we will activate the WinterTrade Dynamic Cycle Explorer. You see here is the series data we are using, and we are doing no special aligning on cycles. So the Cycle Explorer will detect on its own which cycle is active. So we are not setting any special lengths here. We're just saying that, okay, it can look between the cycle length of 30 and 100. So this is a standard parameter set to look for which is the current dominant cycle within this financial stress index here. And this is how it will look like if you just activate the Dominant Cycle Explorer here. So we have the 9th of June, which is currently this value here. And in the below window, you will see the detected cycle. So you see a cycle length of 78, which means that we have a dominant cycle of 78 weeks, which is currently active in the markets. And you see the blue cycle is the theoretical cycle, which is detected, and the red cycle is the real cycle of the real data. And if you have an alignment between the red and the blue plot, you will see that it's quite visible that this cycle is active in the markets. It's just highlighted here with some lines on the chart. So you see the cycle top here is aligned with this point here, the cycle low, the cycle high, the cycle low, cycle high, cycle low, cycle high, the cycle possible cycle low. So you see the dates here. You have to be the important thing is that you need to flip it around if you now put this analysis to the stock market data, because a low within the financial stress index means that we would expect a market top at this point here. So these are the dates. So at the December date here, we would expect the market top, where this high in the financial stress index should correlate to a market low in the markets here. So now let's map these dates onto the real stock market here and just see how it looks like. So in this chart, we see a mapping of these cycle dates onto the real, in this case, New York Stock Exchange composite series here. So this is the first top, the low, the top, the low, the top, the low, the top, low or more sideways, and now expecting a top here. You see the cycles, the dominant cycles within the financial stress index could be aligned with market tops and lows in the market here. So I want to pinpoint the interesting fact of the analysis, and this is where and how we use the Dynamic Cycle Explorer, that it projects a current cycle low within the financial stress index here at the current date of the analysis, which would pinpoint to a market top at the point of the analysis here. So this is what we're looking for, where to expect the next turn within the dominant cycle, which has been detected on the financial stress index, not on the price index. So we are just mapping the cycle from the dominant sentiment index on the price chart here. And we see that we should expect a turn in the financial stress index, which is very low, and the dominant cycle would expect the financial stress now to move up from this low point here. So this means on the current day of the analysis, we would expect the market to top. So this is just one thing of the analysis. If you're familiar with cycles, it's not enough to do just one dominant cycle analysis. You need to combine this with other cycles, like other time series data, like you use another source, or you need to use another length for your chart. So this was the weekly chart. So another index I would recommend to do a sentiment analysis is the so-called volatility index, or just the abbreviation VIX index. So this is often related to a so-called fear index, and this also expresses a kind of nervousness in the financial system regarding volatility in the markets. So very low points in the volatility index would correlate to market tops, and very high levels of this VIX or so-called fear index. So if we have a high VIX or fear index in the market, high volatility would correlate to market bottoms. So the interesting point of the VIX is that we have daily data. So we will open a chart for the volatility index on a daily basis, which is done here in our When2Trade platform. So this is how the volatility index looks like. It's plotted on the chart. Also here again we have the 9th of June at the day of our analysis. And for sure we will do the same thing. We will apply the Dynamic Cycle Explorer, which is able to detect the current active dominant cycle within these sentiment index series here. We use the same standard settings and just put it on the chart, align it with the major high or low. So we just aligned it to the major high here in the series in the year of 2011 here. So what pops up here automatically is this detected cycle. So in this instant here on the 9th of June, the Dominant Cycle Explorer detected a cycle length of 155 bars. So this is the dominant cycle on the daily series. So you just have to check if the blue theoretical ideal cycle correlates to the red a real data set. So we have a good correlation here between the real series and the detected ones. So we can put this as a valid projection here. And what you see here now, is quite similar to what I've shown you on the financial stress index here. So we can see the dates, the low in the VIX index and the high in the VIX index are just marked with concrete dates, so we can map it to the real price series here. But however, you already can observe that the expected cycle bottom is projected for the 17th of June. So just next week from the point of our analysis here on the 9th of June. So we are arriving at the current expected fear market low. So also this second sentiment index would project a current sentiment low in the market. So this is completely different source. Instead of using the financial stress index, it's a different time frame. So in this case we're using daily bars here, and it's a different cycle which is detected here. But now, and this is what makes it important if you're familiar with cycle analysis, now we have cycles within cycles alignments, because we have two different cycle analysis which pinpoint to the same market juncture here. But before we go to this now, let's map this volatility index cycles to the market. So you can see these dates just marked here from our analysis on the dominant cycles within the VIX index, mapped onto the chart. So a low within the VIX index will correlate to market high. This was the market a market low, so a high in the volatility index. This is a market high, so a low point in the volatility index, and vice versa. So, and what you've seen here, that on the 9th of June we expected a lowest point in the volatility index, so a turn in the sentiment cycle on the daily chart. So we expect increasing volatility, which means that the market should turn down at a date of around the 17th of June for sure, not 16th, it's the 17th June here in this case. So please excuse this. So we have one fear cycle on a daily basis, which projects a market top in mid of June of 2014. So exactly at the point of the analysis. In addition to that, and this is what I've shown you just before, the weekly chart on the financial stress index published by the Federal Reserve Bank of St. Louis also projects a very sentiment cycle low at the 9th June. So we have the cycles within cycles alignment here, that both analysis project sentiment cycles low in the market. So we expect the fear level to increase, or the stress level now to increase from the 9th of June's ongoing, which means that we expect also the markets to turn down now. So, and this is what you will get a clue out of cycle analysis. So, and this is a very important juncture here, as we have now a sentiment cycles within cycles alignment. These situations don't occur every day. So this is what you're looking for if you're trading on a daily chart. You need just to be calm and look out for these situations where you really have good cycles and cycles alignments, and not on the price chart within sentiment data sets. So I've shown you here two interesting sentiment cycle sources, so the financial stress index and the VIX index, on two different time frames, which I would recommend to you to have a closer look if you put cycle analysis on. So you can use for sure different cycle platforms out there. I've automated all these cycle detection here on my own platform, which is for sure available if you're interested here. But I'm more pinpointing to the general cycle analysis on sentiment vehicles here. So what I've shown you here now in this seminar session is not cherry-picking example which would have worked or which should be interesting. So this was the live analysis I've posted in real time in the public internet magazine. So I'm hosting a blog with some analysis, and on the June 8th, so one day before the June 9th, I've exactly published these charts here in the public internet area. So you can review this public forecast, which I've done in June here for real. So it's not something after the fact. This was posted live. I've just reviewed how I've done this analysis. And now why it's important? Let's see where we are today. Today we are now at the beginning of October, mid-October. This was the situation we have reviewed, which was done live in real time. So now let's see how this played out. So this is the New York Stock Exchange Composite Index, and we observed, I mean, not on the day of the analysis, so the market moved just 2 weeks higher, but we have the biggest drop for the year. It's a drop of over 10% just in the markets here. And if you review from the European point of view, if you just remember in the beginning of this session, I've shown you that the German DAX index just reached the level of 10,000 points, and here it is just from this point of view, it was the highest point of the analysis, and it lost also over 10% after this point. So just one day after the analysis, the high was reached on a closing basis by this index here. So our analysis was exactly up to the point, to the day, to detect the high for the complete year here. So I mean, now the magazines come out now and again reveal. So this is how the situation looks on. This was our signal. Markets dropped over 10% here now, and now you go into the media, and now they are revealing first Dow drops 300 points after year's biggest gain. However, the baseline is it was the worst point decline since June 2013. So we observe now the biggest drop for over 1 year in the markets. Another resume is that from the Reuters news magazine, that for sure now in 2014 we just moved into negative territory for the year. So, and we had our worst weeks since 2012. So these drop gave us the baddest weeks since 2 years now. So we had the biggest drop on a daily basis for 1 year. We have the worst weeks since May 2010. However, from a cycles point of view, this is not surprising. We saw this situation coming at the 9th of June, where we expected the sentiment cycles to turn, and this correlates with market's top, and this was exactly the case again on 9th of June. So you can also review now CBC Business News here. Dow plunges over 300 points. But however, the baseline here is the drop was enough to wipe out all the gains for all 2014 on America's most closely watched stock indicator, the Dow Jones. So after the fact, now the media is coming around the corner and telling us that these are the biggest drops on a daily basis, on a weekly basis, and it wiped out all gains for the full year just within weeks after our signal on 9th June. If you go more into the details, what's happening in the financial condition of the market, so there's an interesting market commentary, market sell-off as global growth is weak and uneven. So what's behind these facts? So one thing is that in the US we have this EMF report, and there are some details stated that it expects the Federal Reserve to start raising interest rates by mid-2015. So we see the stress level is now again going up, and that there is an increased risk that some financial markets may overheat. So, I mean, we are not surprised by these news. So what you see here is exactly that the media now reports that financial stress is expected to go up. However, this was reported in October. We forecasted this to happen just in June of this year. So we have a similar situation if you review the conditions in Europe. So there was a commentary of a French here stating that France is finished, so finished in terms of its economy. So in addition to that, there came on the back of a message about disappointing German industrial production figures. So, and also in Europe, you see these indications that financial stress and fear is now going up again. So again, this is the market situation at the 8th of October, 3 months after we put on our cycle analysis. So our cycle analysis showed on the 9th of June that we have arrived at the low point regarding the financial stress. I mean, markets have a little bit lagging indicator, as I mentioned before. Cycles within sentiments are leading indicators. So you would not expect on the 9th to the markets to turn down, but it's the turn date. So from the 9th June on ongoing, you would expect the markets to go down. And this is exactly what happened, and not just a little bit. Yeah, the market dropped the biggest for years on a weekly basis, on a daily basis. All gains for this year wiped out. So what's the point? Financial stress is back again. Surprise, surprise. However, cycles have shown you the picture in advance, and we have been warned, and we know that around June, July, this summer, the markets would start to turn down. And this is exactly what happened. It happens again and again. However, not every day. Is the important point here is you need cycles within cycles alignment. If you have two cycles on different time frames, different sources, with indicators from sentiment sources in alignment, you have a high probability that this correlates to market turns. I mean, I've shown you this live, so this is not a review of the past. This is just the review of a live forecast, which is available for everyone and which was posted on the 9th of June. So finally, if you review the media news, which I've shown you around this market situation here, that mainly the mainstream media was just bullish regarding stocks and just posting the market will move up, don't be skeptical about these up move, markets will go on for the next years. However, now some months later, the media shifted, even the big media, their reviews and said, okay, we turned down. If you are a cycle expert on now, or if you are familiar with how to apply cycle analysis, I've shown you here, you would not have been surprised. Cycles showed us this sentiment change in advance. So again, if you have the tools, if you know how to apply it, I mean, it's just a matter of knowledge how to apply it. So what's the takeaway of this presentation here? First of all, you can review the live post here in the public internet just to make sure that this is not just a cherry-picking presentation here. Please review the original forecast and charts which I've posted here in the public internet section here. You can review this source or just visit my blog page here for free. So you will see that I've exactly used this analysis here to pinpoint for the financial stress turns here, which correlates to market turns. Second point here is, and I mean, you need nothing, just please take away that use sentiment data sets like the St. Louis Financial Stress Index or the Volatility Index to put cycle analysis on. If you have your own practice with cycle analysis, I would just recommend use these two data sets to put your cycle analysis on. I mean, if you want to look for additional or new tools, for sure you are invited to join the Venture Trade platform with the Dynamic Cycle Explorer, which was used here in this example, just spotted these two dominant cycles by a mouse click and guided us. And the third step is, if you want to read more all the knowledge which was used to build these kind of forecasts, it is published in a public book section. It's about $30, so it's really not much. You can buy the book at Amazon. I'm just telling you, the name is Decoding the Hidden Market Rhythm Part 1. You will find the book on Amazon, so feel free if you want to read more about it. So hopefully take away, you have been a little bit interested now in cycle analysis on sentiment cycles, but however, I've shown you the practical guide in the financial markets here, as you have seen that you're really able to predict turns. And again, we have been able in the year of 2014, we predicted the market top for this year, and the job afterwards is the biggest for the last 2 years. So I think you see the practical usage and that it really works in real conditions here. So thanks for your listening, and yeah, just feel free to ask questions or to research more on your own. Thanks for your time. Bye.